Welcome everyone to the Daniel Krugen Associates Wealth Management Review for September 15th, 2022. Today's presentation is titled Investing and the Fed. My name is Rocky Istvan. I'm the Chief Compliance Officer and Associate Wealth Manager at Daniel Krugen Associates. Daniel M. Krug, CEO and Senior Wealth Manager, will be joining me today. Just a reminder, this presentation is for informational and illustrative purposes only. If you have questions or need advice, just please call the office and we will handle that with you. Our agenda, we're going to talk about kind of where we're at in the economy right now for September, get an update on the inflation and what the Fed is doing. We're going to go into a little bit of investing and staying focused during this crazy year, and then kind of summarize everything we went over.
So, lots happened this week.
Yeah.
I mean, Tuesday was kind of a funky day for everybody, especially the market.
Yep.
So we've got a lot to go through here, but we'll go through in a pretty quick time. And ready to roll?
We got the football season. It was a crazy first week for football, and it's a crazy week for the market. So welcome to September, everyone.
That's right. Maybe we should have the football theme going right now.
Yep.
Okay, so I'm going to take a look at the economic indicators. And as most of you know, we ultimately look at the economic indicators literally every time we sit down and do these webinars. And the reason is the economic indicators are what gives us the indicator as to where the economy and the financial markets are going. So let's take a look at September 2022. Now, again, a quick recap on how this works. The economic indicators are forward-looking, so they're actually looking forward 6 to 9 months. Which means wherever the dials are or whichever direction the dials are going kind of gives you an idea of where the economy is going. And in this month, we've had some changes over August and not necessarily good. So here's what we have. The monetary policy's gotten a little bit more red. The leading indicators and corporate profit growth, they actually moved quite a bit. And now they're both sitting right on neutral. And then we have greater geopolitical risk. So there's a lot going on with this, and I again have to focus when you're looking at this report here, these speed dials. Each dial is an indicator that we're looking at and making a determination as to which direction the market is going and how do we handle our portfolios to make sure that we get the best out of them on the other side of a market correction. Now, last week or last month, we took a look and a deeper dive with inflation. And we talked a lot about how inflation is influenced by the current situation with our oil prices and ultimately gas prices. Now, since then, we know that prices have gone down, and I'll talk a little bit about that and how that relates to inflation. You know, here's the interesting thing. The economic data really kind of flashes very mixed recession signals. And I'm going to go through a couple points here which will kind of illustrate why some people say we're in a recession and some people say, no, we're not in a recession. So let's just talk about how they kind of look at it from a recession standpoint. First thing, in August, the jobs report showed an additional 315 jobs. And at first glance, we're going to say that that looks positive, but this is actually the lowest gain since April 2021. So what does that mean? It's actually the addition of jobs is actually starting to wane. So again, when you think about the economic indicators, this is kind of following the charts where the charts are saying that things are slowing down here. Now, secondly, and this is an important thing, and I think this got missed by a lot of people, and that is June and July's jobs numbers, they were revised down by 170,000 jobs. Again, that's a negative right there, and it kind of spells, or it leans towards the argument of us being in a recession. Now, you've got the unemployment rate ticked up a little bit. You know, it's slightly above the 3.5 we had in June, which, quite frankly, was one of the lowest rates on record since 1969. So that is a positive. Generally, when you're in a recession, you don't have unemployment this low. And then the worker pay grew. It grew by 5.2%. And that's a pretty big jump year over year, and I would say that's another positive. And again, another argument on the side of the recession is not here yet. So you take some of those, and I'm going to add some more to this, because there are other signals that we look at that ultimately are signaling on a negative side. So let's go to the first one. And this part really took a lot of people by surprise. And that is, we had another record high inflation reading of 8.3%. That's, again, a negative. When inflation is high and you mix it with some of the other indicators that they look at relative to whether we're going to have a recession or are in one, this kind of spells we're in a recession type thing. And then the biggest one people look at is the 2 consecutive quarters of negative economic growth for the U.S., and it is a common definition of a recession. So if you look at the GDP in Q1, quarter one, was down 1.6, and Q2 was down 0.06. So that would be a negative. That says that indicator right there says that, hey, I think we're in a recession. Now, like I said, that's not the full definition. So they do look at other indicators. And if I back up again to point number 3 and 4 here, where the unemployment rate is still in good shape and the workers' pay grew, those two positives are what's kind of getting some of the staunch, hey, it's not a recession. That's what they're basing most of this on. And the reality is, if you, again, look at where we're heading, I think it's relatively safe to say we're pretty darn close, if not currently in a recession. So now, let's jump over to inflation. So inflation, Rocky, you know, we already mentioned that it's up 8.3%. Yeah. And, but let's talk about, and I want to show you a chart on how the trend is going and what's influencing it right now. All right?
Okay.
So let's go on. This chart here is a 12-month chart. It gives you the percent in CPI for all urban consumers. And we've got 2 lines on this chart. One, the blue starred, is all items, and that's the number that most people see. The other one is all items less food and energy. Well, I don't know about you, Rocky, but I need food, and I certainly use energy. Yep. So it kind of leads me to that top line. But let me show you some interesting information here. Now, in June, we were at 9.1%. That was our high. Now, it came down a reasonable amount in 1 month to 8.5, and that's where the current regime effectively was saying, hey, look, everything's getting better, inflation's coming down, we're going to take care of this. And then, what happened in August? It dropped again, but it didn't drop as much. It was a much softer drop. And ultimately, this is the thing I think that Rocky people are feeling right now, and that is, if you look over the last 2 years, so if you go back to the last 2 Augusts, this August we were up 8.3% inflation-wise, and then August 2021 we were at 5.3%. You add those together over the last 2 years, 13.6%. Now, why are some people feeling the inflation? Well, let's go back to the pay increase that everybody has been getting, the year over year being 5.2%. Well, let's face it. Let's say we doubled that in 2 years, we were up 10.4%, but yet inflation was up 13.6. I think we're still going backwards, and that's the problem. People are finding that their money just isn't going as far, and that is showing more of leaning towards the recession argument in the books. So when we move forward, we look at gasoline prices in June, and this is where we had the high inflation. It was at $5 a gallon. You fast forward to today, we're at 3.89 a gallon. So that's a significant drop. You'd think if gasoline dropped that much that inflation would have gone down further, but it didn't. So the question is why? Well, let's go to the all items less food and energy. You can see we stayed flat for 2 months at 5.9, and then we ticked up to 6.3, which is a pretty decent increase for all the rest of the items. And you can see why at that point the all items inflation didn't go down as much as people were anticipating. Matter of fact, they were anticipating an 8.1% number, and it fell short of that. And again, if you look back to August 2021, the all items less food and energy ended up over 10%. Again, significant because it kind of, just those numbers kind of wipe out the pay increases that people have received. And it certainly hits the lower income people more than the high income earners. So that's why you're seeing that many people are feeling the heat right now. Now, the other aspect is looking back last year or 2 years ago, the last 2 years leading into the current regime's administration, we've got August 2019, our inflation was 1.7%. Well, wouldn't we like to be back there again? And if you look at the following year, it was at 1.3. Again, you can say what you want about the way Trump talked, and a lot of people didn't like it, and I get it. But if you just look at the pure numbers rationally, I think most of us would say, boy, I'd like to go back to those numbers. It was a good time. Gas prices were low, inflation was low, the GDP was looking good. We were energy independent. We were all on at that point. So it's interesting when you look at those numbers and start kind of analyzing what's going on. I think if we're not in a recession right now, I think we're right on the heels. So we can mince data if we want, but the leading indicators are saying that we're not out of this yet. And the Federal Reserve is kind of looking at it the same way, if you think about it, in the track record they've had. So let's talk about the Federal Reserve. Now, Fed Chair Powell vowed to raise rates to fight inflation, and he's going to do it until the job's done. So he is very determined at raising the interest rates to get this inflation under control. But to some degree, he's pushing an uphill battle, and he's got to thread the needle here. So let's talk about some key points relative to what happened this week. First of all, Jerome Powell said Thursday he is strongly committed to fighting inflation despite the current regime's out of control spending. In other words, if we're going to be printing money, if we're going to be spending more than we're bringing in, that is going to create a problem, and that's making it very difficult for Powell to get the inflation under control. Second, the Fed has raised the benchmark interest rates 4 times this year. I mean, that's a lot. With the Fed fund rate now set at a range between 2.25 and 2.5. And that's before the rate hike that is actually coming next week that he announced 2 days ago?
Yep.
Tuesday? So what happened Tuesday? The S&P reacted in early hour trading to Powell's scheduled 0.75 rate hike with a sharp drop at the open. And it ended the day down 4.32%. And realistically, when you're looking at Wednesday was kind of an up and down seesaw in the S&P 500. Didn't move a lot, and I think everybody's just trying to digest how that's going to really react in the future. So it's really interesting the way things are playing out right now. But I think from an economic indicator standpoint, let's just call it what it is. We're either on the heels or in a recessionary period. The interesting thing also is they don't usually call it until when?
After.
Yeah, like months afterwards. So let's mark our calendar today and let's look back to see when they called the recession. So that kind of brings us to you, Rocky. You're going to talk about investing and staying focused.
Right. With everything going on, I think a big part is stay focused. Stay on your plan. We made plans, but I want to help you a little bit with some affirmation of how to stay focused. So let's move on.
All right.
I will take over from here. So I've showed this before. Equity is normal. Or equity volatility is normal. Reminder what this chart says. The blue bars represent where the S&P ended the year at. The red dots below it refer to some point in the year, the intra-year decline. So again, if you look all the way at the left of the chart, 1980. In 1980, the red dot represents about a 17% intra-year decline, and the blue bar represents the S&P actually ended up the year at 26% positive. That is a lot of volatility, okay? And as you go across this page from left to right, looking at the blue bars and the red dots, you can see that there were many, many years that the market ended up in a positive, but somewhere during the year it was down. And where are we at today? When you're looking at 2022 all the way to the right, we're down about 24% in the S&P in September with 3 and a half months to go here. So we've still got some time, but there's a lot of volatility with everything that's going on in the economy. When we talk about the bond market and look at the bond market relative to its volatility, it's not near the volatility of the equity markets. But go all the way to the right side of the page and you can see that this year, 2022, the bond market has gone down 12.6%. It's a little bit off that low right now, but it's the year's not over. So when you look at everything from left to right, the red dots and the blue bars, you notice that there really is not a lot of volatility in those red dots for over the last 40 years since 1980, but you have to go all the way back, Dan, to 1980 and look at, that was the last time we had a huge decline in the bond market, 8.8% down at one point in the year. However, the market ended up 2.7% for bonds. So my point with this is we haven't seen volatility like this in the bond market. And that's what's different this year than in previous years that we've experienced with bond volatility. When you look at investment returns, they are not earned evenly. This chart shows us the orange bar represents the average of the S&P annual return since 1980 through 2020. Over 10%. You look at that number and you're saying, well, that's a pretty good number. I don't mind that. But look at how many times the blue bars, the annual year by year market return was either above or below that bar. So we don't get 10% by getting 10% a year. We get 10% by being up 20 or 30 or being down 5 or 10 or 20. So that's what this is representing. There's a lot of volatility, and you have to be in the market for longer periods of time to capture those kinds of returns. Another thing.
Wait a minute. You forgot something on that last slide, Rock?
What did I forget?
I see a quote at the bottom. The stock market is a wonderfully efficient mechanism for transferring wealth from the impatient to the patient.
That's correct. And I
Albert
guess
Einstein.
Albert Einstein was the original sayer of that. I know that Warren Buffett was also quoted as saying things similar to that, but it's true. You have to be in the market and you have to go through market cycles to get those long-term rates of return. Now, we want to talk a little bit about diversification, because that's another factor when you're looking at getting solid returns year over year out of the markets. This is dealing with annual returns by asset class from 2002 to 2020. The key is on the right side of the chart. The key is U.S. equities, U.S. small, or the different asset classes are U.S. equities, small, mid caps, international, emerging market, U.S. bonds, high yield, international, and emerging market bonds. And you see they all have a color code next to their asset class. Now when you go back and look at the chart, all you got to do is kind of just take a step back and look at the chart as a whole and realize that year by year, the asset classes that outperform the others, it's a rotation. It's not usually the same asset class year after year after year after year. So that's why you have to be diversified by asset class when you're investing in the market. Another thing you have to consider from a diversification standpoint is market sectors. And the key to market sectors is on the right side here. You've got communications, consumer discretionary, staples, energy, financials, healthcare, and so on. And those are color-coded also. So when you look now at the graph, year by year, you see how much sector rotation takes place yearly, or every so often, that maybe this year the best performer, next year is one of the worst performers. So being asset allocated by sector and class is very, very important to stabilize and get the growth out of the stock market over those longer periods of time. I really like this chart because what it does is it compares the S&P 500 index, the pure index, with a diversified portfolio. You can see this in the green bar at the top. And what the diversified portfolio is a standard 60 equity, 40% bond type portfolio, and compare the returns in different periods of time against the S&P. So if we look at 2000 to 2002, that was actually a very bad time in the market. It was a bear market. The market in that 3-year period returned a negative 37.6%. However, a diversified portfolio that was set up correctly would have mitigated a lot of that loss, and you would have been down only 16.2% over that 3-year period. However, you don't have a smiley face with that because you still feel like, well, I lost money, but nowhere near what the S&P did. The next period, 2003 to 2007, was a 5-year bear market, or a bull market. Really good returns on the equity side, a cumulative 82.8% cumulative return. How did the diversified portfolio do? Well, not as good, but I don't think 74.4% is a bad return. But what you tend to do when things are good is compare your portfolio to the S&P. So you're kind of like, well, I didn't make as much. 2008, the S&P was down 37%. The diversified portfolio did its job. It mitigated the losses, and you still felt like you lost money, but you were not down like all equities were. 2009 to 2017, coming out of the Great Recession, we had a great bull run here. Good growth in the S&P, 258.7% cumulative return during that period, and the diversified portfolio only did 153.7. 2018, they were about the same, just down a little bit, pretty close to each other. 2019, great year for the stock market, 31.5% return in 2019. The diversified portfolio only did 21.3. Boy, I don't feel like I made as much as I should have. That's how you felt. And then the first half of 2020, these charts have been done quite a while ago, but they make the point. June of 2020, the market was up 18.4%, a diversified portfolio, 12.6. But I think what's interesting about this is when you look at the total return from 2000 through June of 2020, the cumulative return of just the S&P index was 283.8%, while the diversified portfolio was not that far behind at 267.7. So that 20-year period, the diversified portfolio did its job. It mitigated the downside and gave you really, really strong, solid returns by staying diversified and rebalancing those portfolios through those years. So the final chart I kind of want to talk to is emotional decisions can be costly to investors. And on the left side, what this is showing is what happens if you just missed some of the best months in the S&P during the 2000 to 20 year period. So the top blue bar is invested throughout. This means that you invested in the S&P in 2000 and you stayed in it through thick and thin. Your $1 million investment in 2000 would have grown to $3.84 million by 2020. If you would have missed just 1 month, this is what's crazy, and I think that month, Dan, was like in March, April, May of 2009 when we finally bottomed in the Great Recession and the market shot up. If you just missed the best month there in 2009, you lost $440,000.
Ouch.
On that potential investment. Oops, I pulled it out 1 month. I shouldn't have done that. I got back in. 1 month cost this portfolio $444,000. And then you can see missing the next best 5 months. Cut your portfolio down significantly and all the way down. When you go to the right side of the chart, this chart is talking about somebody that stayed invested from 2007 to the end of 2020 versus somebody that was like, the market's going down, Dan. It's 2008. I got to get out of here. And they don't get out right away. What do we tend to do? When it gets near the bottom, I've had enough, and we sell out. And then we're afraid to get back in. So what this is showing is the dark blue line shows somebody getting out when the S&P was actually down at 45% and didn't get back in until the market actually returned to its previous high. Okay, it's back up where it was. Okay, I guess I can go back in the market. Well, if you look at the lighter blue line, the gray blue line, it shows how they didn't make anything because they pulled out. When they got back in, where it says I'm in, when the market recovered, the market actually went down a little bit. So they immediately had that loss and then recovered from there. But if you would extrapolate these numbers to $100,000 initial investment, if you'd have just stayed in the market, your $100,000 would have grown to $350,490.
Wow.
By pulling out and not getting into, you felt like the market recovered, you would only have made $210,000. That's a $140,000 difference.
That's a huge number.
It is. Number. So the point of this is, let's summarize a little bit. Markets are volatile. This is nothing new. You can see it over the past 40 years. Market sector and asset class performance is constantly changing, and it's no indicator of future performance. So you don't want to try to chase returns. You don't want to try to pick the hot trend, the hot sector, the hot stock, because next year it might be the worst performing, which we're seeing.
And typically is.
Which we're seeing with the tech sector.
Yeah.
You know, go buy Facebook today, Meta, down 56%, yet just a couple years ago it was a high flyer, right?
Yeah.
So we don't chase markets. It's time in the market, not timing the market, along with proper portfolio diversification and rebalancing that greatly improves your chances for growing your wealth. So that's kind of what I wanted to go through and just kind of remind people. We're in the market for a reason. We're looking for those long-term returns.
Yes.
And we're not going to stray off course.
Absolutely. And it's interesting, all those numbers, and you had some great quotes in there. And they're all true, and it's really a matter of, I love the one from Benjamin Graham that basically said, even the intelligent investor needs help
Yeah,
to stay on track. And that's
because
why
it is emotional.
it is emotional, and it's tough. It's tough not to follow the crowd, and that's why it's so important to have a wealth coach help keep you on track.
Yeah.
So let's talk about some portfolio actions for September of 2022. You know, many of you have seen parts of this from last month. Some of the actions that were taken, we did underweight overall exposure in the equities portfolios. We sold a lot of emerging markets, a lot of Europe, because at the end of the day, with what's going on in Europe right now, they are not expected to come back as fast as the US market. So we did move from Europe, from Asia and emerging markets, and moved back home with a lot of the portfolios, and really focusing on the quality defensive blue chip type stocks right now. More value, less growth. And on the fixed income side, if we have any, which is a much lower exposure because of what's happening with the fixed income markets, we've increased the investment grade exposure and the high yield muni exposure in many cases. And we also, in looking at what the specific money managers have done, is they've changed the duration and the sector exposure and security selection relative to fixed income. And it's all done to go a little bit more defensive. From an equity standpoint, there has been a move away from mid and small cap, bringing a lot of it down to, in some portfolios, down to zero. There's further lowering exposure to cyclical industries, the ones that, again, high flyers before. Fixed income, again, looking at increasing the investment grade. And really, we've had a lot of high yield, but it's starting to take it on the chin a little bit, so there'll be a reduced exposure there. And the other aspect is cash. We have, if you recall from the last workshop and really any meetings we've had, we increased the cash exposure to about 10% in all the Profile 5 and Profile 6 portfolios about a month and a half ago. We're again not liking a lot of what we're seeing from the economic indicators. So we will be looking to increase the cash position in accounts by another 15%. We will be taking into consideration that each client is different. Clients have life insurance, cash value, that's kind of like cash right there, kind of it is, and fixed income annuities. So we will be looking at each one of these each client to determine how are we actually going to make this work for you. But you will see a major move to cash positions, and one of the big reasons is we do feel there is still a downturn. And under normal bond conditions, we'd probably be moving over to bonds and stay fully invested.
Right.
But we know we're not in a normal bond situation. Cash seems to be the only alternative right now, or cash alternatives. So we will be looking at this over the next few days to move a lot more to cash. And what that does for us, knowing that we believe that the market's got another downturn coming, and it could very well be up to another 10%, it keeps our powder dry. So when we see the opportunity and we see the capitulation on the market, and the indication is, hey, this thing's on the end of it, the recession and the downward market, we are going to go all back in again. And think about it. All we need to do is pick up 3, 4, 5% delta, and we will see a significant impact for the other side when the markets get back to even. So that's what we're looking at doing. If you have any questions on it, please give us a call, and we will look at yours individually. But do expect that the cash position will be increased in the days to come.
Yeah, we're using cash as a bond alternative right now.
Really, because it's the only safe haven. And Rocky, the reality is we had to do that in 2008 because in the midst of what was happening in 2008, the financial crisis, the bonds were having the same problem we were having right now. The only difference is they closed high. Yeah. They came back. Right. And that was because of all the influx of money and propping up the financial industry at that point.
Right, and they reduced interest rates to zero where we're in a rising interest rate environment. So bonds are, if rates are going up, bonds tend to go down. That's just the bottom line. So.
Yeah. So there's a lot going on right now. Hopefully that gave you an understanding of what we're looking at relative to the markets, the economy. And again, we are looking at this stuff on a day-to-day basis to make sure that we position you the best possible to come out on the other side ahead of the game. So that being said, I know a lot of people have questions. You can take it to YouTube because we've got a lot of videos on YouTube right now. A lot of them that are snackables where you can go in and watch them for 3 minutes, 5 minutes, 10 minutes, or you can look at the whole presentations we've had over the years if you really want to see how we were really positioning clients during different market cycles. And from a wealth management standpoint, again, we take all this into consideration, not just the investing part, but really wealth enhancement, wealth transfers, looking at wealth protection to make sure everything you've worked so hard for is kept, and charitable giving, looking at ways to enhance what you're doing there as well. So we're more of a holistic firm. That's what we do, and we do it well. And gosh, we like doing it. So it's been a pleasure. Again, if you want to go to the Daniel Krug & Associates YouTube channel, you can do that. If you go to our website, the reality is you can go to DKNA YouTube, click on that, and it will bring you directly to our YouTube channel. I'm having problems with my clicker here, so it's not quite moving like I wanted to. So I'm dragging it out a little bit. But you can go there, get the latest videos that we have. Some of them are really short, some of them are longer, and kind of pass them on to your friends. Give them the information that you're getting so they can kind of keep their cool during these market cycles. So you take care of your family and
we'll take care of you.
All right.
So we're ready for the future working with you guys. We hope you have a great day. Thank you for joining us.
Yes, and like Buzz Lightyear says, to infinity and beyond.
Have a good day.
Bye-bye.